Right now, there's one number sitting underneath almost every retirement plan in the country. £12,547. That's the full new state pension for the 2026 to 2027 tax year, and if you're short by just 3 qualifying years, you don't lose a small slice of it. You lose £1,075 a year, every year for the rest of your life, and replacing that privately would take close to £27,000 sitting in a pension pot doing nothing but plugging that one hole. Most people over 55 ask the same question. How much state pension will I get? Fewer people ask the question that actually decides the answer. Do I have the 35 qualifying years the system needs from me? Or have I got gaps I don't know about? The Department for Work and Pensions doesn't pay you based on what you need in retirement. It pays you based on years recorded against your national insurance number, and those years can go missing for reasons that have nothing to do with how hard you worked. £1,075 a year doesn't sound dramatic on its own. But spread it across a retirement that could run 25 or 30 years, and it's closer to a car replaced in cash, or several years of council tax, quietly missing from an income you assumed was locked in and rising with inflation for the rest of your life. I want to walk you through the arithmetic behind that £1,075 figure, why a career that looks complete on paper can still fall short, and the annual deadline each April that closes the door on buying back years from your past. Once a year falls outside that window, no amount of money brings it back. To receive the full new state pension, currently £241.30 a week, you need 35 qualifying national insurance years on your record. Fall short of 10 years altogether, and the payment isn't reduced. It's zero, nothing at all. That catches people off guard because most of us treat a long career as automatic protection. 30 years in the same trade, a solid CV, decades of tax returns filed on time. None of that is what the Department for Work and Pensions is actually counting. It counts years specifically marked as qualifying on your national insurance record, and a working life can run 25 or 30 years long while still leaving holes nobody flagged at the time. Sit with this for a second, because it's the part that catches people hardest. You can work full-time for 40 years and still not reach 35 qualifying years. Working and qualifying are not the same test, and the record doesn't correct itself just because you were busy. This isn't about being lazy or avoiding tax or doing anything wrong. It's about how the system tracks the parts of a life that don't fit a standard 9-to-5 career path. A few years abroad on secondment, a stretch of self-employment where profits sat below the threshold, time out of paid work looking after a parent or a grandchild. I've watched this catch people who did everything they thought they were supposed to do and still came up short on the one record that decides their pension. There's a second trap layered on top of the first, and it hits a specific group harder than most. If you were contracted out of the additional state pension at any point before 2016, common across the NHS, teaching, local government, and large company final salary schemes, a deduction called COPE applies. COPE stands for Contracted Out Pension Equivalent, and it does one of two things to your number. Either you need more than 35 years to reach the maximum, or your starting amount under the new rules sits below that headline £241.30 figure. None of this shows up as a warning on a payslip. It shows up decades later, quietly, as a smaller number than the one you'd built your plan around, the same way a smaller than expected energy bill discount only gets noticed once the winter bill actually lands. And this is where it's worth pausing on how the caregiving gap actually happens, because it rarely looks like neglect. A parent steps back from paid work for a few years to look after a young family, and the household simply assumes national insurance is being credited automatically, because child benefit is being claimed somewhere in the house. Often it is. Sometimes the claim sits in the wrong name, and the credit goes to a partner who didn't need it, while the person who actually stepped back gets nothing recorded for those years at all. But the rules are only half the story here. The real shock isn't the year count. It's what a single missing year actually costs you in money you'd recognize from your own bank statement. There's a mental shift that changes everything about how you treat your national insurance record. Stop thinking of the state pension as a bonus on top of your pension pot. Start thinking of it as the most expensive asset you own, and treat every missing year as a debt you'd have to repay privately to get the same guarantee back. The state pension carries something almost nothing else in your retirement plan carries. It rises every year under the triple lock, and it pays out for as long as you live, no matter how long that turns out to be. Your SIP or workplace pension doesn't do either of those things automatically. If you want that same guarantee from your own savings, you have to build it yourself, and building it costs far more than most people expect. Let's run the numbers on a single missing year. The full new state pension works out to £12,547 a year, spread across 35 qualifying years, so 1 year is worth roughly £358 a year for life. Miss 3 years and you're down £1,075 a year. Every year, permanently. Now price out what it would take to replace that £1,075 privately. Using a standard 4% safe withdrawal rate, the same benchmark actuaries and financial planners lean on when they turn a pension pot into a sustainable retirement income, you'd need a lump sum of £26,875 sitting in your own pension just to generate that one missing slice of income. 3 years of gaps in your national insurance record equals nearly £27,000 of extra capital you'd have to find, save and invest, with no guarantee it grows fast enough to keep pace with inflation the way the state pension does automatically. I used to tell people to focus almost entirely on building up their private SIP and treat the state pension as background noise, a nice extra once retirement arrived. I was wrong about that. It's an easy mistake to make because a SIP balance sits in front of you on a screen, growing or shrinking, while the state pension sits quietly in the background until the day it actually starts paying. Once you actually price out what it costs to replicate that inflation-linked, guaranteed for life income, the state pension turns out to be the most expensive thing in your entire plan, and also the cheapest one to fix while you still can. If you're in that window between 55 and 65 and want to make sure your 35-year foundation is actually solid rather than assumed, it's worth subscribing to this channel. We track these DWP changes as they happen, so your plan doesn't quietly crumble the day you stop working. So if 3 missing years can cost you close to £27,000 to replace, the obvious question is why so many long careers end up short in the first place. There are 5 specific gaps that do most of the damage, and most people have never heard of at least one of them. You've already met the first ghost, being contracted out of the additional state pension before 2016 through a scheme like the NHS, teaching, local government, or a big employer's final salary pension, and finding that COPE deduction sitting quietly in your calculation. The second ghost is working abroad. Years spent in Spain, in Dubai, in the United States, paying into a completely different system, count for nothing in your UK national insurance record unless you specifically arranged voluntary contributions while you were away. A decade abroad can feel like a decade of career progress and still register as a decade of silence on your pension record. The third ghost hits the self-employed. If your profits sat below the small profits threshold in a given year, you weren't required to pay Class 2 national insurance, and unless you paid voluntarily, that year likely isn't qualifying. A lean year in business, exactly the kind that happens to almost everyone at some point, can quietly become a lean year in retirement too. The fourth ghost catches part-time workers. Earn above the lower earnings limit £129 a week for the 2026 to 2027 tax year, but below the primary threshold, and you're treated as having paid national insurance without a penny actually coming out of your wage. Earn below that lower earnings limit, common in a lot of part-time and school term time jobs, and the year doesn't count at all, even though you were working the entire time. The fifth ghost is the quietest one. Caring years. If you were raising a child while claiming child benefit, but the claim sat in your partner's name rather than yours, the national insurance credit attached to that year went to them, not you. Years spent looking after a grandchild can also carry a credit, called Specified Adult Childcare Credit, that almost nobody applies for because almost nobody has heard of it. This is where the two paths split. Ignore the gap, keep working to your state pension age, and discover at 67 that your income runs about £1,000 a year short of what you assumed, meaning an extra withdrawal from an already stretched private pot just to cover something as ordinary as the winter heating bill. Or spend a few £100 now to secure £358 a year for life, which works out to something close to a 40% return in the first year alone, before the triple lock even adds anything on top. You might assume you can fix any of this whenever it suits you. You can't. There's a rolling deadline currently erasing parts of your national insurance history, and it doesn't wait for you to notice. You can normally only pay to fill gaps in your national insurance record from the past 6 tax years. Once a year falls outside that 6-year window, it's gone. Not expensive to fix, not difficult to fix, simply unavailable at any price. Picture it playing out. It's April in a future tax year, and you finally sit down with your national insurance record and notice a gap sitting in a year from 6 tax years back. The new tax year has just started, and that older year has quietly sunsetted out of reach the moment the calendar turned. That £358 a year for the rest of your life is gone permanently, not because you couldn't afford to fix it, but because you didn't know the clock was running. Buying back a year you catch in time is more straightforward than most people expect. It's a single payment, arranged directly with HMRC once the Future Pension Centre confirms it's worth making, not a complicated application or a means test. A voluntary Class 3 national insurance contribution for the 2026 to 2027 tax year costs £18.40 a week, which works out to £956.80 for the full year, a bill roughly the size of a year's car insurance for a lot of households, paid once instead of every 12 months. Run that against what it buys you. £956.80 spent once, against roughly £358 a year for the rest of your life. Once you reach state pension age, divide one by the other and you get a payback period of a little under 2 years and 8 months. If your state pension age is 67, that means by the time you turn 70 that £956.80 has already paid for itself, with years of pure upside still ahead of it. Very little else in a retirement plan pays back that reliably, that quickly, or with that little risk attached. But before you reach for your card details, hold on. For a meaningful number of people watching this, spending that money is a genuine waste of cash, and the reason comes down to one thing most people never check before they pay. It's completely natural to feel a jolt of urgency the moment you see a gap flagged on a government record. The page is designed to make it look like you've failed a test, and that feeling pushes a lot of people straight toward their card details. But panic is a terrible substitute for arithmetic, and for some of you, paying is the wrong move entirely. Start with what I'd call the 35-plus club. If you're 58, you already have 30 qualifying years, and you're planning to keep working until you reach your state pension age. You're going to reach 35 years naturally, without spending a penny. Buying additional years in that situation doesn't add a single pound to your pension. It simply hands the government money for a year you were always going to earn anyway. Then there's the credit claimants, the group most likely to be paying for something that was already free. If you spent time caring for a grandchild while a parent went back to work, or looked after a sick relative, you may already qualify for a national insurance credit rather than needing to buy a year at all, claiming that credit costs nothing. Buying the equivalent year outright costs close to £900. Checking which situation you're actually in takes a few minutes and can be the difference between a free year and an unnecessary one. I remember a viewer who wrote in after spending £2,700 buying back 3 years, only to realise partway through the process that he was already on track to work until 68 regardless. He'd have hit 35 qualifying years without touching his savings. He effectively handed the government an interest-free loan he'll never see again. So, how do you actually know which camp you fall into before you spend anything? It comes down to reading one specific line on your state pension forecast correctly, and most people read it the wrong way round. Before you do anything else, pull up your own state pension forecast on gov.uk. It's free, it takes a few minutes, and it's the only place that shows your actual national insurance record rather than an assumption based on a typical career. Look for 2 separate numbers on that page. Your current forecast shows what you'd receive if you stopped working today. Your forecast at state pension age shows what you'd receive if you keep working and paying in until you reach it. Most people only glance at the second number and miss how much distance sits between the two. Then scroll down to the year-by-year breakdown of your national insurance record. Each year is marked either as a full year or as a year that isn't full. Every year marked as not full is a candidate for one of the 5 gaps we've covered: contracted out years, time abroad, low self-employment profits, part-time earnings under the threshold, or caring years that should have carried a credit. Before you pay to fill anything, call the Future Pension Centre and confirm the payment will actually raise your pension. The number is 0800 700 175. That call costs nothing, and it's the single step that separates people who fix a real gap from people who pay £900 for a year that was never going to help them. The state pension is the one part of most retirement plans guaranteed to rise with inflation and last exactly as long as you do. It's worth building your plan around the real number, not the assumed one. If you found this useful, stick around. There's more coming on how these DWP rules keep shifting under people's feet. A plan built on a number you've never actually verified isn't a plan. It's a hope. And hope isn't a financial strategy.